Hello, hello. Welcome to our live webinar on student loans. Today we have with us our very special guest. We have Loretta Shotsberger from Enders Insurance. They are helping to provide this webinar to you today. So Loretta, how are you doing today?
I'm great. How are you, Rebecca?
I am great. Thank you. To get started, I just want to go ahead and we're going to start it with our market update that we do every time. And then I'm going to let Loretta talk for just a couple minutes to give you some updates with the insurance industry, because there is definitely some stuff going on that you want to know about for you and your clients. And then we will hop into the main part of the webinar. So, okay. What is going on? Wait, do I have the wrong one? Oh my goodness. I have too many screens open. Hold on. Bear with me 1 second, folks. I clicked on the wrong PowerPoint. There we go. That's the right one. Okay. So current market update. Consumer Price Index came out this morning. Now, this is important because remember, as inflation goes up and down, so does I still have the wrong one. What is going on? I am so sorry. We'll just go back to this one. So I am terribly, terribly sorry. It's literally too many screens. That's the problem. Okay, so CPI, Consumer Price Index, came out. I just got to find the right slide. There it is. And it was 0.4 this morning, which was above expectations. We were thinking inflation was going to come in at 0.3. So this took our year over year inflation to 3.7, which actually stayed in line with where we were last month for a headline inflation number. Remember, we dropped off September of 22, which was 0.4. We added September of 23 up, which was also 0.4, which is why our headline inflation number did not change. Now, right after that, you have the core inflation. So this is the Consumer Price Index, but it strips out food and energy. So these are things that the Fed cannot control, is food and energy prices, but they can control some of the other prices. This also came in hotter than expected at 0.3, but we were replacing a 0.6 number here. So you can see that because we did that, the core inflation reading actually dropped a little. When you put the two of them together, you can see that the purple is the core inflation and the gold is the headline inflation number. Now, also keep in mind, Producer Price Index actually came out yesterday that measures inflation on the wholesale side. And that also came out with higher than expected numbers. And both of these numbers, when they came out, actually hurt mortgage bonds. So pricing did not get better yesterday and today because of the inflation numbers. The biggest thing that's driving up inflation right now is fuel prices, because fuel prices have increased. All right, so I'm going to pass it over to Loretta here. And Loretta, can you give us a quick update of what's going on with the insurance and anything else that you want to let us know about?
Hi, yeah, thank you. Just quick introducing myself, Loretta Shotsberger. I'm with Enders Insurance. We're an independent agent, and we work with a multitude of different carriers. And right now, I can honestly tell you we are in what is called an insurance hard market. Rates are hardening. Carriers are definitely taking a stance on home risks in particular, where they are definitely coming down hard on certain characteristics of homes. Big items right now that we're seeing are roofs. They definitely don't want to insure any older roofs. Some carriers are restricting 15 years and newer. A lot of carriers are taking a 20-year or newer stance. So whenever you're working with a client, I think that it is really good to know what is going to be expected in terms of insurance, right? Because if you have a risk or a property that has maybe older systems that are going to need replaced, making sure your client is aware that, hey, you could actually have difficulty securing insurance unless this is on your radar to be updated, and factoring that into what their budget looks like and what their expenses are going to be after closing. So whatever education I can provide, I'm here as a resource. Even if you're not looking for an insurance proposal, I'd be happy to look at a risk for you, let you know what you're going to run into, or even offer a proposal with the carriers I do have access to. Pricing is increasing, renewals are increasing. And I think that's going to be the trend. They're actually projecting that we'll be in this hard market till around 2025.
Yeah.
So,
and from what I've seen and heard, the renewal increases are hitting the South harder than it's hitting us up here in Pennsylvania. But I've had friends down South that it's tripling when we're doing their renewals.
Florida, California, Texas, they're really getting hit hard. And fortunately for us here in PA, insurance is segmented according to your territory. So your zip code, they look at population density, they look at losses that have hit your particular area. But with weather patterns, the intensity of storms, that's increasing, and that's not expected to get better, right? Like nature is what it is. And with all of these factors, increase of building costs, increasing contractors' cost, all of these are really hitting the insurance market hard. So, but we're here for you here at Enders. We're here through the long haul. We're not going anywhere, and we are here to support you in whatever we can do, whatever aspect we can, we're here for you.
All right. Well, thank you for the update. I know we're definitely seeing it on when our clients are going out and getting insurance, they are definitely coming in higher than they used to. Mm-hmm. And that 20-year roof thing, we're hearing about it more and more. So agents, just be prepared if you're listing a property where the roof is over 20 years old. If your your seller could produce anything showing that they put 50-year shingles on it or anything like that, that's going to help the buyer get insurance.
Had it inspected, anything you have to get your seller more ammo or in a better position to sell. Or if you're working with a buyer, get your buyer aligned to maybe make some adjustments in that negotiation that will bring everyone ahead.
Yeah. All right. Well, thank you very much. And thank you for sponsoring. We do definitely appreciate your support. And we have been sending people over to Enders Insurance, and Loretta has been doing a fantastic job for our clients.
Thank you.
Okay. So the whole reason why you're here today is to talk about student loans, right? So I'm going to give you some statistics as we go through this and how we can help your buyers, number one, save money so that they can purchase a home. Number two, save money so they can actually qualify for a home. And number three is increase their purchasing power when they go out to buy a new home. Those are our goals by helping people lower these federal student loan payments. So 17 million student loan holders are currently renting right now. So that's a lot of people that we can help as both lenders and as agents that we can get them into homes. And 45 million student loan holders owe $3.6 billion in debt, which is a lot, right? So let's give you a quick backstory here. So March 13, 2020, the CARES Act was passed. And y'all have heard about this. What it did was it took federal student loans and it put them in forbearance. It froze the payments. Interest rates on them went to zero, and people no longer had to make their payments. Now, this obviously during COVID helped out people, especially if they lost jobs or whatnot. But at some point, they had to come back, right? But it was a flip of a switch that it was turned off. And this is from the National Bureau of Economic Research. It says, we estimate that student loan payments pause immediately increase consumption as borrowers use that new liquidity to increase borrowing on credit cards, mortgages, and auto loans rather than avoid delinquencies. And you can see this by these charts right here. So you can see where the pause actually happened. Here is payments for auto loans. The pause happened here, and look at the payments, how they've increased. This is the balances people had on auto loans, and look at how the balances increased, during 2020, 21, and 22. And here it is for credit cards. Look at how high credit cards have gone up, which is probably why we have hit over now $1 trillion on credit cards in the United States. That happened in August. When you put it together with cars, mortgages, and credit cards, you can see how people's payments increased and how the balances increased. So student loan payments, where did all the money go that they get? Where, they saved money, but it all went to mortgages, car loans, credit cards, and everyday living expenses, right? Because we know inflation has hit and people had to pay more for everything. Now, whoops, went backwards for some reason. There we go. So the Fiscal Responsibility Act, this was passed on May 27th. Biden signed it into law. And you know this as the Debt Ceiling Act. Remember, we were up against the debt ceiling and we had to pass a bill in order to raise our credit limit in order to continue being able to make our bills as the United States. And in that, a lot of people didn't realize this was in it, but in it was that student loans had to start going and being repaid. So September 1st, 2023, interest started accruing after 41 months of people not having to make student loan payments. That was over 3 years people had off. Now, some people still made payments. You were still allowed to, but you didn't have to. So 41 months, people got used to not having to do that. And turning it back on, this is like opening up or waking up a sleeping giant, right? Everybody who was on pause for these student loans all of a sudden now has to start paying them again. And here's the thing that a lot of people didn't realize. If you were delinquent on your federal student loans in 2020 when they went on pause, you were coming out now, September, you came out of being on pause in delinquency. And that's really important to know, because if you were pre-approved for a mortgage or your client was pre-approved, now they have late payments on their credit report again. Because during that time of being on pause, credit reports the scores got better because those late payments got over 3 years old. So they weren't affecting the scores as much. So it was really important that people were taking care of this, ideally prior to September 1st. But, at this point, we're beyond that. So we're just trying to help people get the correct information now. So what they need to do, anybody who has federal student loans, they need to talk to somebody like us and create a plan. Now, whether they're a first-time home buyer, they want to move up to a bigger home, or they need to do some debt consolidation, this is in their wheelhouse. If they have federal student loans, this is something that they should definitely be talking about. So as I said, when these payments came up, the big thing was anybody who was late or in default, that was going to hit their credit reports. It could cause issues for home buying, because now all of a sudden there's different payments that we have to use. And it's opening up the door for more people to have to do debt consolidation because of these payments starting. So how does it all work? So this website right here, and we'll go back and add it to the descriptions after the webinar here, but it's a very simple website that you just have to put in a couple pieces of information. You have to know your household income, your student loan information, so how much you owe and what the interest rate is, and how many people live in the house. And it is actually that simple. So you take that information, you input those, 3-4 pieces of data into the website. It calculates your savings and shows you your options in order to lower those federal student loans. So by lowering these federal student loans, our whole goal here is to regain some of that lost buying power that they lose by having this payment. So now that payment's here, it's taken away from how much money they have to put towards a mortgage every month. So that's what we want to do, is lower that payment, start helping them save more money so we can increase how much they can afford. In some cases, it just helps them qualify altogether. Or in other cases, if they're not ready to buy yet, still going through this process helps them save money so that they can purchase a home down the road. So a first-time home buyer, let's look at them. Even a $300 payment could hinder them from buying a house. And that's because it's affecting their debt-to-income ratio. So by lowering that payment, we can help lower that debt-to-income ratio. And you have the same thing with a move-up buyer. So maybe somebody needs to relocate for a job, or they need to right-size their house. Maybe they've had children the past couple of years and they need a bigger house. Or maybe they just need to downsize because they're a little bit older but still have those student loans, and they just need to restructure some of their debt. So for those people, we're going to do a first-time homebuyer analysis or a move-up analysis. And I'm going to show you an example of one of these here in a minute. But basically, we're going to sit down with them. We're going to show them their different options for where they are now, what happens if they reduce their federal student loans, and where they could be. Because managing your student loan debt is going to aid in those home ownership goals. Because our first step is to schedule a meeting. Let's talk it through and let's come up with that plan. And step 2 is preparing all their financial information. So we're going to have to get some of their documents from them, and we will be able to turn that into Loan Sense to lower those student loans and come up with a plan going forward from there. Oops, it keeps going backwards. There we go. There are some key mistakes that people make that we definitely want to let you know about. There's 13 million student loan holders that are eligible for income-based repayment and are not in the program. So think about how many people could be paying lower monthly payments for their student loans than what they're actually paying right now. That's a lot of people. And 71% of people fail to get their federal student loans forgiven because of paperwork errors. So the way it works is, depending on who you work for, if you have federal student loans, if you work for a nonprofit, you can actually get those federal student loans, or I should say a servant, like you work for the county or like the VA, for example, you can get those federal student loans forgiven in 10 years. So if you are filing the correct paperwork every year and you're in an income-based repayment program, after 10 years, you can actually get those student loans forgiven. If you work for a for-profit, then it's 20 or 25 years. You have to talk to the servicer, or somebody at Loan Sense can help you with this. And as long as you're filing the paperwork, you will get them forgiven. And that's one of the biggest mistakes, is people don't file the correct paperwork because it has to be filed every single year. And they're filing it correctly and not having paperwork errors. So you definitely want to make sure that you're taking care of that. Now, some other things I want to let you know when it comes to key mistakes that people make is private student loans. This is only for federal, not for private, but a lot of people refinance their federal student loans into a private student loan. And you do not want to do that, because once you refinance it into a private student loan, you are never, ever eligible for income-based repayment programs, and you're never eligible for that loan forgiveness. So you want to make sure you're staying in the federal program and not refinancing into the private. And these private student loan companies, they are vicious. If you're not getting the spam emails already, like I don't even have student loans and I'm getting those emails, they're really trying to, to get you to refinance it. They're targeting a lot of people to get them to refinance it into private. They're showing things like adjustable interest rates at 4%. Well, read that fine print, right? They're partnering with banks so they can show the FDIC logo on it. They're getting student loan holders to consolidate into these private loans, and then they're giving that information to their mortgage departments to call on them to do refinances then and refinance it into the house. So these are things that you need to know, and student loan holders out there need to get this information so they are not, they're making good, wise decisions. Google has actually banned any advertising on student loans from these private lenders because of the issues that they're causing. It's also important to know, if you don't know your federal student loan rate, they're usually 6 to 6.5%. And trying to think if there's anything else. Okay, I think that's it for that slide. I do just want to see if there's any questions yet. If you do have any questions, go ahead and put them in the chat, and I will do my best to answer those for you. So we're trying to help more buyers with student loan debt to achieve home ownership. So 2/3 of student loan borrowers can adjust their payments. 2/3. So that's a lot of people out there that could be saving money. And on average, every year, there is $300 million in loan volume turned down that could have been originated if loan officers were informed about how to lower federal student loans. And the whole process to lower these federal student loans, we use LoanSense, which is a third party. I do not get paid a penny to use them. I actually have to pay LoanSense to have access to their calculator. So it's actually kind of reverse. But from start to finish, you can do this in 21 days. So the 21 days from the time we say, hey, LoanSense, we need help, we can save these clients some money. They work with your servicer, get it all restructured, save you that money, and it's finished. And they're able to deliver back to me the paperwork that we need for your new mortgage that shows your new payments. And on average, this is also a really good number. LoanSense is able to save people $90,000. They're able to increase purchasing power by $90,000 on average. So that's just really huge. So again, step 1, 2 minutes it takes to input that information into the computer online. Step 2, the borrower has to complete the LoanSense information. So you have to upload your servicing information, your student loan information from your servicer. And step 3 is LoanSense will work with you and then send us the letter that we need for your mortgage. And like I said, it's all done in 21 days. Now, there is something called the Fresh Start program. So this is for borrowers who were in delinquency or in collections on their federal student loans going into the pause that happened in 2020. They get a one-time, you can go through the Fresh Start program. And it went into effect September 1st, and it stays into effect for a full 12 months. So you have until September of 2024. And what this does is it lets you enter into a program where they're going to put you into an income-based repayment program. You have to make 9 payments on time, and they will go back and remove all the delinquencies from your credit report and all your late fees and everything from previous to put you into a good financial situation. So if you were behind, definitely go through this. You can still use LoanSense to go through it and enter the Fresh Start program, because it's going to save your credit and it's going to get you back on track. One thing that what we can do, if you are in a situation and you go through the Fresh Start program, getting those delinquencies removed from your credit report is huge. And we can do what's called a rapid rescore. So we actually have your credit report updated, showing those delinquencies taken off. And that's going to help you get a better interest rate on your mortgage. Now, the question that we are still trying to get an answer on, if you're doing any type of government loan, we do have to check you on a website called CAVERS, which the government has. And basically anybody who's delinquent with the government is on this website, and we're not allowed to do another government related product for that person. So if you are in delinquency, that means you would show up on CAVERS, and we are trying to find out if going through the Fresh Start program takes you out of that system, which I would think that it would do. Now, there we go. I want to tell you a story. I have a friend across the country who is also using LoanSense, and she was talking to a borrower that she had who was a county worker. Now, this county worker is a psychiatrist that she has $330,000 in federal student loans. $330,000, that's a lot, right? She refinanced her federal student loans into a private student loan. When she did that, her payment was $4,200 with the private student loan. Had she talked to a loan officer like us that uses LoanSense, she could have only been paying $1,400 a month. That's sickening, right? Like to know that you're having to pay $4,200 a month when you could have paid $1,400.
That's crazy.
But it gets worse because she was, she's a public servant, so she would have had her loans forgiven
And it would have been forgiven. Oh my
yeah,
God.
and she was 3 years away from that when she did this.
Wow.
So, I mean, that's life changing, right?
Yeah.
I just can't imagine, going through that, knowing that you, lack of a better term, you screwed yourself, right?
Like, how do you get out of that? Like, is there any way out of that?
She's going to be paying $4,200 a month for a long time.
A very long time.
It's probably a 20-year loan. I'd have to do the numbers, but yeah, crazy.
Wow.
So let me show you. This is LoanSense, and this is what it looks like. So when you click on it, you just have to fill out some quick pieces of information. And let's say you make $50,000 a year, and you have $25,000 in student loans. You don't need to fill out credit cards and car loans and stuff. 6.5%. If you are married, your family size would be 2. Look, this person that we just made up there could save $237 a month in their student loans by moving to an income-based repayment program. And it increases their buying power for a mortgage by $33,000, which is just crazy. And even if it's you and you're just signaling, I can't say that word. You're not married, it's still $141 a month at your savings. So it's definitely worth looking into this, because that might pay for your gas for the month, right? Probably wouldn't pay your electric bill anymore, but it depends on where you live. But it's definitely a savings. Even if you have, let's say you make $70,000 and have $35,000 in federal student loans, it's $202 savings. And look at this, just changing it to $100,000, still $202 in savings. So you can see making $100,000, you would think that, I probably make too much, I don't qualify. Well, you actually do.
So it just essentially restructures the way that you're paying your loans back. It doesn't necessarily mean you qualify for leniency or partial forgiveness, correct? It's just restructuring it to make it more affordable until you can either reach your loan forgiveness, or am I following correctly?
You are.
Okay.
Yep. So it all depends on what the person's goals are. Is it their goals to pay off their student loans as quickly as possible? Or is their goal to, I want to pay the minimum I can until I can get these forgiven?
Right. And be able to live.
Yes.
So,
and for a lot of people, that's exactly what it is. I was talking to somebody who, look at these numbers. She makes $70,000. She went to a private school.
Oh my
she
God.
has $350,000 in federal student loans.
No. Oh my God.
Yeah. That is actual numbers. It's crazy.
And with the way the market is right now, like, you have to amp up your buying power as much as possible.
Exactly.
Because the market is not giving you a thin budget to work with.
Exactly. See, you got it. Yes, but the important thing is, I will tell you, the first time you use LoanSense, it is $249. And that is for them to go through everything. They will do a 30-minute counseling session with you just to make sure you understand how everything works. And then they will go to your servicer. They will get the student loans restructured. And like I said, provide us with the correct paperwork that I have already received some. We've already sent them through underwriting, and we are good to go. It's just to help people save money, increase their buying power, or just qualify altogether.
Mm-hmm.
So now I do want to show you a couple more things. So prior to these student loans restarting, these are the mortgage guidelines, depending on what type of loan you're looking to go into. So Fannie Mae requires us to take your loan payment or your loan balance, whatever you owe, and 1% of it is your payment that we have to count against you. Well, that's actually a lot of money in some cases. Freddie Mac and FHA are 0.5%, and VA is 5% of your balance divided by 12. But if you are in true repayment, we have to use the actual repayment. And I've seen some loan officers, and this really irks me because they're sending out wrong information, because they're saying we've already been using payments for your student loans, so it's no big deal that they're starting. And yes, it's true, we have already been using it because we've been using this guidelines right here, but the actual payments in a lot of cases are higher than these guidelines right here, unless you're an income-based repayment. So that's why it's so important for you to talk to somebody who actually knows and understands this information. So that's the first part. And then the second part is, if you, let's say you have a husband and wife, you both have federal student loans. When you go to do your household income here, it goes off of how you file your tax returns. So I'm going to show you an example of a husband and wife filing separately and then filing together. And this is what LoanSense does with you. They walk through all this to see which is going to be the better option. Should you file separately or should you file together? So these were actual clients of mine. The husband made $85,000. He has $64,000 and change in federal student loans. So he can work with LoanSense and save $376 a month. Now the wife doesn't make quite as much, but also doesn't have quite as much in student loans. Let's just say it's $50,000 and $30,000. She can save $80 a month. Not huge, but it's helpful. If they file together, they're at $135 and $94. Oh, wow. So I'm going to put this in a chart for you. So if they file separately or they file together, this is how much they will save. So which is the best way? The best way is filing together in this scenario, because they can actually save more money if they file together than filing apart. But that's the stuff that LoanSense is going to walk you through. Now, let's look at an example here. This is somebody who is pre-approved for a $200,000 loan, putting down 3%. So they were getting a loan of $194,000. This is back in August, okay? Before student loans had started. Now, rates are a little higher than this, but we're going to go with the scenario. So let's say the rates were 3. Wouldn't that be great? 6.875. Their payment for that mortgage would, all in with taxes, insurance, and mortgage insurance, would be $1,761. Okay. But over here, they have that $750 student loan payment that's kind of in the background that they forgot about, right? So now it's September, and now that payment is starting, or interest has started September. First payments were due October 1st. So if you take that $1,700, add that $750 to it, you're still in the same loan, but your cash that you have to pay out of pocket now every month for that mortgage and that student loan, all of a sudden it is $2,500, right? Are you following me on that?
I'm following.
Okay. So then the client calls LoanSense, or they, through us, get to LoanSense. Same $200,000 loan, but now their payment on that student loan is only $250. So it drops their monthly outline to just over $2,000, and they're saving that $500 a month.
That's massive. Do
you think somebody would appreciate that?
Yeah. I mean, $500 a month, that's huge.
It is huge. It's $600 or $6,000 a year. So
that's a trip to Costco.
Especially if you have a family, right?
Like one trip to Costco. Let's be real.
But here's the really cool thing. You might say, you know what, Rebecca, I can afford that $2,500 a month, but the house at $200,000, I'm not finding what I want. And that's very possible because home prices have increased. So by using LoanSense and by lowering that federal student loan, now I can take your loan amount up to $255,000. Your payment for that loan plus your $250 student loan is now, let's just round and say $2,500 a month. I'm still $15 ahead monthly for you, but I just got you into a higher priced home by using LoanSense and saving money on those federal student loans. Is that wild?
That is wild. And I love how you tied it all in with an example.
Yeah. So if anybody has any questions, you can put them in the chat. If you're watching on YouTube, you can write them there and we'll definitely get back to you. I answer all those questions myself. If you have any questions on this, want some help, want us to walk you through it, I'm going to put the link for LoanSense in the comments. And we'll put Ender's insurance information. So if you want Loretta to help you out with insurance, you'll be able to have their contact information as well. But do you have any questions, Loretta?
Actually, yeah. So the LoanSense process, is that just like, can you do that at any time? Or is that just at like when you're going to purchase something? Like what, I guess, would be the benefits of someone working with LoanSense? Like a refinance? Or does it have to be a new purchase?
No, you can do it at any time. So this was a scenario of a first-time home buyer, but it definitely could be for a move-up buyer, as well. We're still doing the same overall method of lowering that payment to help you increase more for your purchasing power.
Right.
Or maybe we need to consolidate some of your debt and your debt to income is too high. Even consolidating the debt, I need that student loan payment lower to get you to qualify.
Right.
But it also just helps people save money,
Right.
That's the whole point here. But you can do it at any time. Like I said, LoanSense charges $249 the first year, and then they will come back to you every year and remind you to do this. They will file your paperwork for you, and depending on what you need done every year, my understanding is it runs from $99 to the $249 again. But in most cases, I think you can just do it for the $99. And why? Like I would pay the $100 every month just to know that I'm filing what I need to. It's correct.
Right.
Somebody took care of it for me. And if you're saving $500 a month, what's $100 a year?
Right. Exactly. Yeah. No, it sounds like a no-brainer to me for sure. Especially if you're in a situation where, you're in. Like I know my one friend is in higher education and in so many years it'll be forgiven. So yeah.
Yeah, it's definitely something that everybody should look at. And now I will say one more thing. There is what's called the SAFE program. So if anybody's ever heard of that recently, Biden basically was trying to make it easier for people to restart these student loan payments. So if you are delaying starting your student loan payments here in October, or if you are paying partial, it's kind of undetermined right now what that means on the mortgage side, because from an underwriting standpoint, underwriters know these student loans have already started and they know you're responsible for paying for them. So if you're not making that full payment or you delayed it altogether, that could affect your mortgage, because if you're not able to pay that student loan payment now, why should somebody give you a mortgage?
Right. You're not going to be able to pay it then.
Yeah.
Yeah.
So make sure you're getting educated on this stuff. Like that's the biggest thing I can tell people. Don't just run out and do. You can do it yourself. You don't have to use LoanSense. You can go right to the servicer, but you need to make sure you're educating yourself on this. And it's also important. I tell real estate agents, if you're accepting you have a listing and you're accepting an offer, I would be asking the buyer side, does this person have student loans? Have they taken care? And does the loan officer know about it? Because right now, because the servicers, their computer systems didn't understand 0% the last 41 months. So now that they're starting to hit the credit report, they're coming in and all of a sudden people are owing all those back payments, all the late fees, all the back interest, it all added on. And all of a sudden people's balances on their credit reports are $40,000, $50,000 more than they actually are, because the servicers are trying to backpedal and get their systems figured out.
So if you're rolling around with a pre-approval letter from like August,
yep,
and you aren't updating that info, you could be in for a reality check. You might want to backpedal. Yeah, that's a really good point.
Yeah. So definitely make sure you're checking out your information and dealing with people that know what they're talking about. That's the biggest advice I can give.
This is really informative.
Well, thank you.
I'm not in the market to buy, and I actually don't have student loans, but this is really interesting. And like, I talk to people all the time. So no, this is really great. Thank you. It's a good topic.
All right. Well, if anybody has any questions for myself, the Rebecca Foot Mortgage team, or Loretta at Enders Insurance, don't hesitate to reach out and we will make sure that we get you connected. Thanks for tuning in.
Thanks, Rebecca.
Thank you.